Hello and happy Monday. Jackie Broman here from TBA Law. So today is the final series that I'm doing on the various types of entities that you can run a small business in. So I did pros and cons of sole trader entity, pros and cons of a partnership, pros and cons of a company, and last week I did pros and cons of a unit trust. This week it's pros and cons of a family discretionary trust. And like I've said for the last 4 weeks in each of these videos, the pros and cons depend on your stage of business, the size of your business, and what your objectives in your business are. And I can't really give advice about pros and cons of a discretionary trust without giving a little bit of background around what a trust is and what's the difference between a unit or a fixed trust and a discretionary trust. So I think I explained last week that a trust is where it's a legal construct, so it's like an imaginary created entity basically, where the trustee, which could be a person or it could be a company, holds assets or runs a business on behalf of a group of beneficiaries, and that forms the trust. So I've heard a trust likened to a little cart that someone might pull behind them. So if you think about a child, and they have a little red cart that they tow along and they put all their toys in the cart. So the cart would be the trust and the toys in the cart are the assets. They're separate from the child. So the child's not carrying his assets or her assets. They're not carrying their own toys. They pop them all in the cart. So if the child falls over, the assets, the toys are not going to spill everywhere. They're in the cart, right? So creating a trust is like creating a cart for the person. If the person themselves has issues, it doesn't affect the income or assets in the trust, like if the person goes bankrupt or the person has a separation. So that's a little explanation about how a trust works. It's a separate entity and it provides some protection for the assets that are in there. So the difference between a unit trust and a family trust is that a family trust is usually discretionary. A unit trust is fixed. So, like I said last week, a unit trust is similar to a company in that the shareholders own certain amounts of shares in that company and the income they get is proportional to their share ownership. Same thing in a unit trust. If you have 100 units in the unit trust and each person owns 20 units, then they each have a 20% entitlement to what's in the trust, right? So that is a unit trust. A discretionary trust has a large group of beneficiaries and none of them have a particular proportion or right to the assets or income in the trust. It is completely discretionary to the trustee. Okay, so each year the trustee determines from year to year how the income is split up between the beneficiaries. So no one might get a thing, or it might all be funneled to one person, or it could be funneled between 20 people. So that is why a discretionary trust is usually only used in a family situation, because it's usually the patriarch or the mum and dad at the top of the family tree that set up the family trust, and it's for the benefit of their children and their grandchildren. And the mother and father are the ones who decide how the income filters down. So that's a family trust. Whereas a unit trust, which is what I spoke about last week, is better for people who are not family members. So people who are independent from each other in running a business in a partnership. And so two couples might come together to run a business, and each couple owns 50% of the units in the trust, right? So their proportions are guaranteed. If they were running it through a discretionary trust and one of them lost control, you can see that the trustee would filter all the income down to beneficiary it liked and not to the others, right? So that's a discretionary trust, and it's used for families usually, okay? So small businesses that are family businesses quite often use a family trust. They were really common, over the last couple of decades, maybe less so in the last 10 years, because some of the tax benefits has been wound back. Accountants used to love them. But again, with the government clawing back as much tax as it can, it has reversed some of the tax benefits that you get in a family trust. The main tax benefit that has stayed in a family trust is because you've got the discretion to filter income out to multiple people. You can filter it out to people who have less taxable income and not to the people with higher taxable income. So it's a great income splitting tool, okay? But that is one of the only tax benefits that remains in a family trust. So, having said all that, you've had a small lesson on trusts. What are the pros and cons of running your small business in a trust? So, as I've said, if income tax and income splitting is an objective of yours, then a family discretionary trust is fantastic, right? But again, you don't want to use a discretionary trust if you're running the business with people who are not in your family. It can cause problems. Capital gains tax, you're pretty safe there. You've got the 50% discount that you have if you own an asset personally. So there's no real downside to owning assets in a family trust. From an asset protection perspective, again, if this is an objective of yours of protecting the assets that you're growing in the trust, of property that you buy, of the business asset, it's one of the best asset protection tools that you can have. Like that little analogy I started at the start of the video with the child pulling the cart with all its toys in. The child falls over, the toys are all still fine. Same thing with a trust. If the individual has a bankruptcy or separation, the assets in the trust are fine. Vice versa, if something goes wrong in the business, it's quarantined in the business and the individuals are fine, okay? So they're quarantined from each other. So you get a 10 out of 10 on asset protection for a small business running in a family trust. Control and succession. So from a succession perspective, and obviously succession planning is my thing, I love family trusts. It all comes down to what is written in the trust deed, and quite often we can change the trust deed to do whatever you need it to do. So from a succession perspective, succession is about who ends up controlling it, right? Making sure the control goes to the right person. So that is all done through the trust deed, not through a will, not anything like that. And the other thing is that because you're building your assets and your wealth in the family trust, it doesn't come under your will at all. So if there is a dispute against your will, everything in the family trust is safe. It can't be attacked. Okay, so that is another great thing about a family trust. Setup and running costs. Now these are a little bit higher, obviously, than running a sole trading business or a partnership, because you can pretty much set those up straight away and off you go. Discretionary trust takes a bit of setting up. You've got to set up a company usually to run it. You've got to set up the trust deed. You've got to set up bank accounts. Annually, you have a separate tax return, and annually you have your ASIC fee of about $160 to keep the company going as well, the trustee. So, you're looking at $2,500 a year to keep this family trust going to run your business in. all right? So again, a startup is not going to run it in a family trust, but they're going to start as a partnership or as a sole trading business. And then once their income gets, you know, $500,000, you need to restructure, look at a family trust. And I also give a 10 out of 10 in flexibility to a family trust. There's huge flexibility around income, there's huge flexibility around assets, there's huge flexibility around control. So I think family trusts are great, but again, it depends on your situation. You can't have a family trust if you're in business with someone who's not in your family. You can, but it might not work so well, so you'd have to be careful. So there you go. I save these videos onto the page when I'm done. So this is the end of the 5-part series. So all those videos will be saved in Facebook. You can go back and have a look at all those, see what's the most relevant for you. If you think this is relevant for someone else you know, please tag their name in it. And of course, contact us if you have any more questions. On our website, we do have the sheet that I've gone through over the last 5 weeks, which is the comparison of all the business entities and the pros and cons with a rating of each. So it's just a 2-page little document. It's a really easy reference. So if you wanted that, you can go to the website and download that. But otherwise, I hope that's helpful. It was a really quick little lesson on discretionary trusts and the pros and cons of doing business in it. But got to start somewhere. So I do this every Monday at 10. So I think up until Christmas, I'm doing a short series on separation. So that's coming up over the next couple of weeks. Yeah, I hope everyone has a great week. Hope it was useful, and hope to catch you next Monday. Have a great week.